Think of debt like a tool in your garage. A hammer can build a house or break a window. It all depends on how you use it. Most people treat all debt like it is a trap that will hurt them, but that is not how money actually works. There is debt that puts money in your pocket every month and debt that takes money out. The wealthy understand this difference and use it to their advantage. By the end of this video, you will know which debts can build your wealth and which ones are quietly draining your wallet. Today, I am going to show you exactly what they know that you do not. Let us start with the debt that actually puts money in your pocket every month instead of taking it out. Most people hear the word mortgage and start sweating. They think business loan means financial danger. But let us look at what these debts actually do for your wallet. While your friends are telling you all debt is dangerous, millionaires are using these exact same tools to get richer. They understand something most people miss completely. Let us break down how a mortgage works. You borrow money to buy a house. Historically, home prices go up over time, and renting out a property can often cover or exceed your mortgage payment. Think of it like this. You use the bank's money to buy something that makes you money. When you borrow to buy an asset that grows in value or produces income, that asset can cover the loan cost and still leave you ahead. You buy a house with a mortgage, rent it out, and the rental income covers your mortgage payment while you build equity in something worth more each year. Student loans work the same way when they increase your earning potential. Education tends to increase lifetime earnings significantly. The Federal Reserve shows the average student loan payment is nearly $400 monthly, but the degree often boosts your income far beyond that payment amount. The debt pays for itself through higher earning potential. Business loans follow this pattern too. Borrowing to invest in tools or inventory can boost your revenue if that equipment helps you serve more clients. Your loan payment might be a few $100s monthly, but you are earning more because you borrowed money to buy income-generating assets. Here's the key difference that separates good debt from the trap most people fall into. Good debt buys you assets that either make money or save money over time. It turns your borrowed dollars into wealth-building tools. In short, good debt turns borrowed dollars into wealth-building steps rather than endless bills. The pattern becomes clear once you see it. Good debt pays for itself, and then some. The house rental income covers the mortgage and puts cash in your pocket. The nursing degree pays for the student loan and boosts your lifetime earnings. The business equipment pays for the loan and grows your monthly profits. This is exactly how wealthy people think about borrowing money. They do not ask if they can afford the payment. They ask if the thing they are buying will make them more money than the loan costs. When the answer is yes, they borrow without hesitation. But there is another side to this story that most people know all too well. Now let us talk about the debt that is designed to keep you paying forever, and why it is so hard to escape once you are in. Bad debt looks appealing up front, but works like quicksand. The more you struggle with minimum payments, the deeper you sink. Credit card companies make most of their profits from people who cannot pay off their balance. They have designed the system to keep you there. Think of it like this. They make more money when you struggle than when you succeed. Let us break down the credit card trap. Americans face an average credit card interest rate around 24.4%. When you carry a balance, interest compounds quickly, doubling small purchases over time. You buy something for $1,000 on credit and pay the minimum each month. That purchase can easily cost you twice as much by the time you're done paying. Bad debt costs more in interest than the asset's value over time, quietly eroding your finances. Payday loans are even worse. You borrow $300 for 2 weeks and pay a $45 fee. That sounds small, but it equals up to 600% annual interest. Think about that. A bank savings account pays maybe 1% per year. You are paying hundreds of times more to borrow money than you would earn saving it. Bad debt costs more in interest than the asset's value over time, quietly eroding your finances. Car loans for status destroy wealth in a different way. Cars lose a chunk of their value as soon as you drive off the lot, so you pay interest on a shrinking asset. You are literally paying to lose money. Bad debt costs more in interest than the asset's value over time, quietly eroding your finances. Here's the psychology behind bad debt. It feeds on instant gratification and social pressure. You want the thing now, even if you cannot afford it. The monthly payment seems manageable, so you ignore the total cost. Each purchase makes you poor, but it feels good in the moment. Let us connect the dots. Good debt buys appreciating assets that make money or save money. Bad debt buys depreciating stuff that loses value. The house you bought with a mortgage goes up in value. The television you bought with credit goes down in value. This is the trap that keeps most people broke. They think they are buying things they want, but they are actually buying debt they cannot escape. The credit card companies know this. They count on it. Now you can see it coming. When someone offers you easy monthly payments, ask yourself, will this thing make me money or cost me money? The answer tells you everything you need to know about what to do next. Here's how to look at your own debt situation and decide what to tackle first, starting right now. You probably have both types of debt mixed together, and knowing which to prioritize can save you thousands. Paying off the wrong debt first is like trying to fill a bucket with holes in the bottom. First, list all your debts and their interest rates. Write down every single one. Credit cards, car loans, student loans, mortgages, personal loans, everything. Next to each debt, write the interest rate. Target any debt with interest rates above what you could earn investing or deduct on your taxes, typically credit cards and payday loans. Now apply the wealth test to each debt. Ask yourself, did this debt buy something that makes money, saves money, or goes up in value? If not, it is likely dragging you down. Your mortgage probably passes this test. Your credit card debt for clothes and dinners probably does not. Your student loan might, depending on how much it boosted your income. Here's your priority order. Attack high-interest consumer debt first. Credit cards, payday loans, and unnecessary car payments go at the top of your list. These debts are wealth destroyers. They are taking money out of your pocket to pay for things that lose value. Keep wealth-building debt longer, especially if the interest rate is low. A mortgage under 5% interest while your house appreciates makes financial sense. The house is making you money while you sleep. That is good debt working for you. Use the debt avalanche method for your bad debt. Make minimum payments on all debts to avoid penalties, then attack the highest interest rate debt with extra payments. Let us say you have $500 extra each month. Do not spread it across all your debts. Put the entire $500 toward your highest interest debt while paying minimums on everything else. Financial pros often suggest keeping your debt-to-income ratio below 40%. To calculate it, add up your monthly debt payments, divide by your gross income, and multiply by 100. If it is above 40%, you are in the danger zone. Focus on paying down debt before taking on more. Understanding good debt versus bad debt gives you a clear roadmap for building wealth instead of just managing payments. Most people spend their whole lives paying off debt that makes them poorer. You now have the framework to make debt work for you instead of against you. The wealthy do not avoid debt. They use it strategically to buy assets while avoiding the consumption trap that keeps everyone else broke. They understand that debt is leverage, not danger, when used correctly. Start by listing your debts today and categorizing them using what you just learned. Put the wealth destroyers at the top of your attack list. Your credit cards and payday loans need to go first. Good debt can grow your net worth. Bad debt drains it. Choose your borrowing like you choose your tools. Remember, debt is a tool in your garage. Used wisely, it helps you build your house, financially and literally. Most people will keep making the same mistakes, but you have the knowledge to break free. If this helped you rethink your debt, hit like and subscribe for more straightforward money tips.